Thank you very much for coming today, Tim. It's a true pleasure to have you here. Perhaps today we can talk a little bit about monetarism. What does monetarism consist of? And we can address some of the criticisms usually put to monetarists and why perhaps it's not being applied in our days as it used to be applied and as I think it should be applied. So can you please tell us in few words what monetarism is? What does it consist of? The principles of monetarism, please.
Monetarism in a way is the same thing as the quantity theory of money,
Yeah.
which goes back to the late 19th century and was developed in particular in America by a chap called Irving Fisher. In fact, you can take it back centuries before that, but the heart of this is that the change in the price level depends on the change in the quantity of money, money being anything that we use to make payments. And more specifically, that if you get extremely rapid growth of the quantity of money, much faster growth of the quantity of money than of real goods and services, that's what causes inflation. So that's the heart of it. Okay. Now, in the 1970s and 1980s, we had rapid inflation in the main economies, and control of the growth of the quantity of money was regarded as very important in public policy and obviously was the heart of monetary policy in some countries. It was very controversial because it replaced previous methods of economic management to a large extent. Inflation did come down when those policies were adopted, and in that sense monetarism was a success. There have been one or two wobbles in the relationship between money and the economy. As I said, the policy was in many places controversial. And for whatever reason, in the last, I suppose, 20, perhaps 30 years or so, there's been a reaction against monetarism and a move to much more eclectic, in my view, rather confused kind of policy making, in which the rate of interest by itself, not the quantity of money, is taken to be key in the setting of monetary policy.
So, as far as I can tell, every time we talked to an economist, a macroeconomist in particular, he or she will tell you that in the long term, the price level is indeed determined by the amount of money in circulation.
Mm-hmm.
So why, I mean, having this consensus about the principles about the determination of the price level over the long term, why would you say that money is not taken much more seriously in the framing, in the making, of monetary policy? Why is that?
I think it's partly evidence and it's partly what monetarism was in its heyday. The evidence is that in the short run there isn't a very clear and reliable link between changes in money and changes in nominal GDP. It's for discussion. I think that in the short run you get many other influences on economic activity than influences from money, and I don't deny that such things, say, as the stock building inventory cycles, world trade, devaluations, these things affect the economy in the short term. Possibly even government spending and fiscal policy does, but I have difficulties with that. And in the longer run, the evidence is much clearer. I think the other reason that monetarism became unfashionable and even unpopular was to some extent what it was seen as about. Milton Friedman was the key advocate of monetarism, and he had a strong belief in the free market and capitalism, which didn't go down very well in some circles. But the other thing was that in terms of applying monetarism, there was a lot of confusion about which types of money were relevant, and also about what was the best method of controlling the quantity of money. Now, I've made contributions to the debates on those issues. We can discuss them if you like.
Yes, indeed, because perhaps the problem is that central bankers and policymakers in general, really, they do focus too much on milder changes in the economy in the very short term. Maybe we shouldn't do that and just concentrate on trends over the long term. So maybe the best we can do is to stabilize the amount of money in circulation in the economy, the quantity of money, a broad measure of money, in order to prevent from major fluctuations.
Well, I think if you say, I'm in favour of stable growth of the quantity of money, and that is the key to macroeconomic stability, then you're a monetarist, and this is a little bit extreme, a little bit cranky, etc. Okay.
But Tim,
No, let me finish. And then we would like this. So you're in favour of unstable growth of the quantity of money, are you? You want instability in the growth of the quantity of money, do you? Indeed. When we do know this, that in the medium and long run, nominal GDP is determined by the quantity of money.
Yeah.
And then those people look stupid. And can I just say that, we've had in the last 30, 40 years, 50 years, I suppose, while I've been involved with these subjects, we've had a number of examples of instability in monetary growth.
Yes.
We had one, and think about Britain, we had one in the early 70s, the Heath-Barbour boom. Wild fluctuations in monetary growth, asset price booms, asset price busts, surges in employment, mass job destruction and so on.
That's something you cover.
Indeed,
very much here.
Absolutely. And then we had another one in the late 1980s, the Lawson boom and the bust associated with joining the European exchange rate mechanism. Again, money growth up and down. Then we had another one in the Great Recession. It wasn't quite as extreme on the boom side. On the bust side, you had a collapse in the rate of monetary growth. Look, to advocate stable growth of the quantity of money, in my view, is not extreme crankiness, it's plain common sense. All right? That should be the heart of macroeconomic policy.
And actually, Tim, if I may say, that was what the European Central Bank did before 2003. Only for 4 or 5 years.
Well, of course.
Tried to do, basically.
With
the announcement of a reference value for the rate of growth of M3 in the Eurozone. Okay. But what happened, as you know better than me, is that starting in the early, but also specifically mid-2000s and onwards, up to the outbreak of the crisis, is that the rate of growth of M3 in the Eurozone exceeded 2 or even 3 times that reference value announced by the ECB. And what did the ECB do? Is to drop the reference value. So it's not that the theory is wrong. It's not that the theory is not validated by the empirical data. It's that at the end of the day, it's policymakers not being, determined and committed to such a policy, because it's a very powerful mechanism, but it also ties the hands of the policymaker, doesn't it?
It's one of the purposes of monetary rule in Britain and America when this was introduced, and also very much in Germany, where, of course, which is really the champion of monetarism, was that the monetary rule would prevent policymakers doing silly things. In Britain's case, repeating the Heath-Barbour boom and so on. There are many little problems. I say they're mostly small problems. They are mostly small problems in the relationship between money and national income. Sometimes things don't work exactly according to plan. Okay. That does not mean there is no relationship at all. That does not mean you can ignore this subject. It does not mean you can allow huge instability in the rate of monetary growth, because if you have this instability, you will get macroeconomic instability as well, as we have seen on many occasions. So, yes, we've done this paper together. In the early years of the single currency, when Otmai Singh was chief economist at the ECB, the Bundesbank was still very influential, there was a concern about the rate of monetary growth. Now, monetary growth was above what was intended, and things still came out okay. But you then had this reaction from saying there's 1 or 2 problems to saying, chuck it out. And so from 2003 through to 2007, perhaps 2004, 2007, you had money growth in the Eurozone, roughly in double digits, more or less,
Yeah.
10% or so a year growth of money.
Up to 12 in 2007.
Indeed. The prices of goods and services still were okay.
Yeah.
But you had very obvious asset price inflation, buoyant economic growth. It's the strongest years for economic activity that the Eurozone has had in the 21st century. And then the Great Recession, dramatic change in the capital regime for the banks at the end of 2008, plunge in monetary growth. So you've gone from very high monetary growth to very slow, well, in fact, actually a period when more money contracted in the Eurozone. What happened? Great Recession. It's a very, very, very sad story in which, there's no consistency in the policy approach when actually they started off in the right way.
Yes, indeed. Maybe we can move on and talk a little bit more about some of the other criticisms usually put to monetarism.
Yeah.
One of them is that, you mentioned them already previously, is that we can't rely on this relationship between the amount of money, the growth in the amount of money on the one hand, and nominal income and prices on the other, because there are lags. There is a time needed for the economy to pass through these increases in money into prices and nominal activity. To my view, and please correct me if I'm wrong, this is very naive, because obviously we should not focus, or we should not tackle minor changes in prices in the very short term. We shouldn't do that. Right. We shouldn't play as a deus ex machina, yes, trying to correct every single price fluctuation in the economy. Don't you think we should just concentrate on, maybe again, sorry for repeating myself, on stabilizing the amount of money in the economy and focusing on the stability of prices, but prices properly measured, not just CPI prices, but overall prices in the economy in the long term?
Well, just to be clear, I think that official policy should be focused on the prices of goods and services, not asset prices. But this is another one of these debates. I mean, in the background here, there's this uncertainty about what's called the transmission mechanism.
Yes, that's it.
It's alleged that the quantitative theory of money monetarists don't have a transmission mechanism. They don't explain, it's all kind of done by magic, that there's money out there and there's prices out there, what's going on in between. This allegation was made by Samuelson, particularly, called the black box. This is rubbish. There is a huge amount of work on the transmission mechanism that's been carried out over the decades, and it was an important part of the work done by Milton, Friedman, and Anna Schwartz. They had a paper in 1963, which, in my view, dealt with this question perfectly adequately. And in my own work, what I've done is to I always look at another key question is which quantity. It's all, as far as I'm concerned, if money matters, all money balances matter. It's broad money we should be using, always. Don't use narrow money, don't use. And then if you split the money balances between the different money holders, between households, companies, financial institutions, then you get a lot of insights into their behavior. Essentially, financial institutions are holding money as part of their investment portfolios. Households, partly they're holding money as savings, but also it's to finance expenditure. And companies are unusual because they usually have bank debts as well as money holdings. So they're sort of... And I've analysed a number of cycles, I've talked about here, money and asset prices, boom and bust, using this framework. It's been picked up at the Bank of England as well, by the way. And there are recurrent patterns in the transmission mechanism. Samuelson, frankly, is wrong. There is no black box about all this. When you get rapid accelerations in the rate of growth of the quantity of money, you tend to get asset price inflation, first of all. That then makes people feel better off. They spend more. Eventually, the inventory cycle comes along as well. Output goes above its trend level. Inflation increases, meaning now prices in the shops, prices of goods and services. And eventually, when you look over periods of 5 or 10 years, money has gone up by 10%. Value of national wealth, asset price has gone up by 10% plus or minus. national income has gone up by 10% plus or minus. It works repeatedly in every country all the time.
I mean, it does. We have collected actually at the Institute evidence, and you have yourself in your work, about this long-term relationship between money growth, nominal income growth, and prices. Indeed.
Yes.
But may I just say that when I said that inflation must be properly measured, I didn't mean that the central bank should target asset prices. I don't think they should to do it at all. But at least not to take the consumer price index target as a sacrosanct definition of inflation. Because at the end of the day, we are just considering the CPI consumer prices, only consumer prices. So we would be disregarding what's going on in financial asset markets. That was what I meant, basically. So maybe
Juan, can I just give you a warning that you may be right, in the Irving-Fisher equation, NB equals PT, there's this T is transactions.
Yeah.
There's transactions in goods and services and assets, please.
Yes, indeed.
Okay.
Yeah.
So the P, the price index, should actually be a price index of goods and services and assets.
Indeed.
Now, actually, I don't know any statistical agency anywhere in the world that puts together those indices on a regular basis, and I have a lot of sympathy with them. I wouldn't do it. But you're absolutely right that money is relevant to both transactions in assets and transactions in goods and services, and the impact on prices isn't just goods and services, not just the prices in the shops. There's asset prices, prices of capital goods, which are being produced in the current period, and so it's a mistake to think that what we're doing is you change money by 1.5% in January to March 2005, and that affects the price level between April and June 2005. That's not the world.
No, the reason why I said it is because whenever I had a chat with the central bank economists before the crisis, before 2007, and I told them about this massive increase in money growth in the Eurozone, for example, before 2007. What they responded to me was, it's fine, everything's fine. We are meeting our target, our 2% rate of growth of the CPI target, and we shouldn't do anything else. That's the reason why. This
is when house prices in Spain were rising by over 20%.
Oh yeah, indeed, every year.
And in Ireland by 30% a year, yes.
So is that, by any standard, is that financial stability? I doubt it.
Yes. Can I just say this is quite important in terms of how one uses this kind of research and how one uses this sort of analysis, that it is relevant to investment decisions.
Yeah.
Okay. Much of my life was spent working in the City of London, was giving advice to large financial institutions about the implications of monetary trends for, yes, inflation, what it meant for interest rates, what it meant for the bond market, okay, but also what these developments in the quantity of money mean for asset prices in general, for house prices, for the prices of commercial property, okay, and also for the prices of equities, okay. It's critical, okay. And when you see, as we have had in Britain from time to time, 30% annualized growth of broad money, even fast growth, by the way, of money held by the financial sector, annualized rates of 40-50%, what do you see? Soaring stock market. Okay. When you get the opposite, you get sometimes contractions of quantity of money, again normally exaggerated in the financial sector, falling share prices. Okay. It's not mechanical. You have always to check everything. There's always some event or something which is an overlay on the monetary story, but actually the monetary story is always there.
So perhaps we can sum up this discussion by, let's say that you have been appointed to become a new advisor to the Bank of England, to produce a blueprint of a new monetary policy strategy. How would you advise the Central Bank, Bank of England, to apply all these things we have been talking about monetarism, in order to conduct a much more stable monetary policy? How would you put it in practice?
Just like Keynes in 1923 in the Tract of Monetary Reform, I'm in favour of a managed currency. And the goal should be low and stable growth of the quantity of bank deposits. This is the deposits of the commercial banking system. Towards that end, there's too much obsession with banks' capital and this kind of stuff. That's not really the point. The important point is stable growth of banks' assets. Okay. They are one side of the balance sheet, and it's deposits on the other, money that's really what's been. The normal course of events, the dominant, we take the last 30, 40 years on average, the dominant driver of the growth of assets is lending to the private sector. And if the lending to the private sector is growing at, say, 3, 4, 5, 6% a year, it's roughly okay. Interest rates are therefore more or less okay. If it's running at 10% plus, raise interest rates. If it's dropping down to nil or something, drop interest rates as far as you can go. Okay. Now, of course, it's possible that you drop interest rates to nothing and still banks aren't lending. By the way, if banks are told they have ever more capital, they certainly won't lend. And that's when the other element in this story comes in, which is the state can create money balances very easily by its own transactions, either the government or the central bank. And it can also destroy money balances, also, by the way. And this is then matters of what's called debt management policy. Quantitative easing was and remains, I mean, it's still there, always there. Quantitative easing was an example of this kind of thing. Essentially, bank credit was very weak, interest rates came down to nothing. The state, central bank in this case, the Bank of England, borrows from the banks, uses the money thereby created to go and buy assets, long-dated government securities from the non-banks. That boosts bank deposits. And that means the state's creation of money offsets the weakness in the growth of banks' assets by lending to the private sector. It's always a matter of judging the forces that are driving the growth of bank balance sheets. Can I just say, you may think this is all a little bit complicated and crazy and eccentric and unorthodox and the rest of it. Oh no. Look, I know people at Bank of England, they do all this kind of work. And when they had to calibrate the QE, the size, the QE operations, this is the framework they use. Can I just say, shambles between the middle of 2007 and the end of 2008 was shocking. But from then on, really, the Bank of England got its act together, and QE was correctly calibrated to deliver low and stable growth of broad money. The economy recovered very quickly. We've had actually quite a stable period the last 5 years.
Well, thank you very much, Tim, for your insights. It's been a very interesting discussion, and I hope we can continue it in the future. So thank you very much.